Hey, good morning once again, options traders, and happy hump day, everyone. And on Monday, I spoke about the differences between a standard condor, an iron condor, and a gut iron condor in response to a question that one of our traders had posted. And we're ultimately leading up to why we might choose one of these variations over another. But before we do that, it's super important to answer this question because you're going to hear a lot of people out there on YouTube touting a certain strategy because it makes all the money in the world for no risk. And this is probably where this trader got this idea, because it's a fancy sounding strategy. People think it's exotic and therefore it must have something special. Well, let's break it down a little bit and find out, does a gut iron condor provide an advantage? And as always, before we do, please be sure to click like and subscribe. It's truly appreciated and greatly helps to promote the channel. So quick review, remember what a gut iron condor is. It is a mix of calls and puts. Your standard condor uses either all calls or all puts, but the iron condor and the gut iron condor use a mixture. So for these slides, we're going to put the stock at 107.50 and 30 days to expiration into a pricing model, 25% volatility, and it tells us that the $100 call is worth $8.11. The 105 call is worth $4.45, the 110 put is $4.52, and the 115 put is $8.24. And the combination of all of these is $7.38. So this is a gut iron condor. We have the calls on the low side. We're long the 100, short the 105. And then we're going to be short the 110 put and long the 115 put. So it's going to cost us $7.38 to put this position on. Now here's where the gut iron condor can get really confusing, and why I think a lot of traders think it has some special properties that just aren't there. Traders will think that their maximum loss is $7.38 because that's the standard formula. The most you can lose is what you spent. And then they'll look at this and say, but wow, I can make $8.97. And for $7.38 down, that's an amazing risk-reward profile. So this is where they start to get caught up because, as I mentioned in the first video, there are some box positions that people are not accounting for. So if we put this condor on for $7.38, this would be the risk graph. Traders going, wait a minute, how can that be possible? How could we be having a maximum loss of $2.38 and a max gain of $2.62? Well, to understand why, it helps to break a condor down into different components. We can look at condors as two vertical spreads, but we can look at the iron versions, including the gut iron, as a short strangle here in the center, wrapped by a wider strike strangle. So notice that we have our center strikes at 105 and 110, and the long strikes at 100 and 115. So if we were to separate those out into strangles, this is what we would get. Here's our short strangle in red. There's the 105, 110. And here's the long strangle in green, 100, 115. So we could also go into our broker's platform and put on this 100, 115 strangle. We could sell the 105, 110, and we would get that risk graph that we saw on the previous screen. They're just two different strangles. But because we have the calls on the low side and the puts on the high side, we get a box position. And this is what starts to make things a little hard to follow. So let's just break down this red one right here, the short strangle. Here's our short 105, 110 strangle. So remember that the stock is at 107.50 and the 105 call is 445 and the 110 put is 452. So if we sell this strangle, we would be selling the 105, 110 in the money strangle for a net credit of $8.97. So why am I reminding you that it's an in the money strangle? Well, notice that we have sold a lower strike call and a higher strike put. All things being equal, lower strike calls and higher strike puts are more valuable. So we're selling that off. We have the obligation to sell at 105, and over here we have the obligation to buy at 110. So if we sell at 105 and we buy at 110, that's a $5 loss. So this is where I keep talking about this built-in box position here. So if we just looked at this strangle by itself, This would be our initial risk graph here in blue, and then over time we might do this, start to appreciate, and then finally at expiration we hit this black line. But notice that the maximum gain is 397. And so why is it 397 and not 897? Well, yes, it would be worth 897, but we've got this $5 box that we have to pay for to close this position out. And so the net is going to be 397. So it could be confusing. So to see it, let's just keep the stock right here at 107.50. Your short 105 call is $2.50 in the money, and your short 110 put is also $2.50 in the money. That's $5. You're short that, so you've got to buy that back if you want to close this position. So yes, the two options individually are worth $8.97, but there's a $5 box in there. So that's what's making this maximum gain $3.97. All right, so hold this thought, and now let's go dissect the long in the money strangle. So if we look at the $100 call, the pricing model says it's worth $8.11. The 115 put is worth $8.24. So if we were to buy this strangle, we would be buying the 100, 115 in the money strangle for $16.35. And again, this is where traders would panic and go, wow, that's an awful lot for this strangle. But they don't realize there's a 15-point box in here. So notice that if we bought this for $16.35, this is our risk graph at expiration. It's only a maximum loss of $1.35. That's the extrinsic value in that position. So for anybody who's new, this is why it's super important to understand how to break an options price down into intrinsic and extrinsic values, also called time values. Otherwise, it's super easy to get lost. So yes, it is $16.35 that we spent, but we're guaranteed to get $15 back, minimum. And so if the stock is between these strikes, we are going to get exactly $15 back, and that's giving us an overall loss of $1.35. So that's what we're seeing down here. All right, so those are the two individual strangles of our gut iron condor. So now let's put everything together. If we sell the 105, 110 in the money strangle, yep, we collect $8.97. And if we buy the 100, 115 in the money strangle, yes, we're going to pay $16.35. That is a net cost of $7.38. At expiration, we're going to have a $5 debit on the short one, but we're going to get a $15 credit on our long. There's a $15 box in there. And so the net between these two is a $10 credit. So take a look what happens if we spent $7.38, but we're guaranteed to get $10 back. That is a net gain of $2.62. And that's exactly what we're seeing here. So why do we have a maximum loss of $2.38? Well, if the stock is above 110 at expiration, both of our puts go out. Remember, the puts are on the high side. The calls are on the left. We're long the 100, short the 105. That's a $5 gain. And so if we spent $7.38, but we also get $5 back from our box, there's our maximum loss of $2.38. Similar thing happens to the downside with the puts. If the stock is down here, now our 110, 115 put spread is in the money. So it's worth $5. We spent $7.38, so there's our maximum loss of $2.38. So that's what the risk graph looks like for our gut iron condor. So keep this picture in mind, and now let's go to the finale and compare this to a standard condor. And I'm just going to use calls. We would get exactly the same thing with the puts. So remember that the stock is 107.50, 30 days to expiration, 25% volatility. With those parameters, the $100 call is worth $8.11, the 105 call is $4.45, the 110 is $2.02, and the 115 call is 74 cents. And if we were to put these positions on, it would be a net cost of, look at that, exactly to the penny, $2.38, and that means the maximum gain is $2.62, exactly the same as the gut iron condor. So the thing that I want you to get from this, really the only message, is to always remember that if you have two risk graphs that have exactly the same maximum gains and losses at exactly the same time, they have to cost the same. Otherwise, it would be an arbitrage. So don't let somebody tell you that you need to start trading these flipped Iron Condors or reverse Iron Condors or all other kinds of crazy names that people give them. Those are marketing gimmicks. They are just condors. There are better reasons for trading these other than just because it's a gut Iron Condor. It's going to be because of skews or the ease of the morph. And so to find out what those are all about, we'll have to wait for the next video. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.